Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Monday, January 19, 2015. The market's closed today for Martin Luther King Day, so what I thought I'd do is make a video which will really encompass the wrap from last week and then into the rest of this week. So what do we have here? We have a daily chart of the SPY, and this right here is how the market closed last Friday. And you see what happened here. This trend line that I had in here pretty much all week long, we definitely, the market definitely defended that line. So we didn't draw that line in. Remember, the market draws this line in. So we just drew a line from this pivot low here through this one. And while we closed down below this we pierced through it one day, closed basically below it or almost on it one day, and then we closed above it 2 days after that. So this line is important, okay, but we're not out of the woods yet. And here's the deal. If you remember from, I believe it was Thursday's video, probably Wednesday and Thursday, I told you that, tomorrow, the 20th, is a cycle turn day. And it's always plus or minus a day. So my preference would have been to go down into Friday, okay, holding this low here, for example, or maybe the 200 period moving average, and then our odds of a turn on Tuesday would have been increased that much more. But since we reversed, we kind of whipped around the last 3 days last week, we were down, we were up. If you look at the intraday from Friday, for example, you see what happens here. We start out up, down, up. So, could that be considered a turn? Yeah, it could be. So what happens is the cycle turn day ends up to be off the table. It's basically a coin toss. Anything goes because we whipped around at the end of last week, finished up. It's always plus or minus a day. So we can actually go up on Tuesday and then down again on Wednesday. And so there's just no way to tell what would happen. So we're going to have to take it one day at a time. Let's go back to the daily chart and let's look at what we have ahead of us. Okay, so let's say that this line holds and we have a nice follow-through day. Then we could certainly go up into these moving averages rather quickly, up in the 204.5, 205 neighborhood. Okay, but if we came back down on Tuesday again, kind of all bets are off, and then you're really consolidating above this 200 period moving average, and then the likelihood that holds if the market went down further gets less and less likely, and then you start getting into this gap window and this gap fill area that I've been talking about, basically between 190.50 and 191.50. In that neighborhood is where the market would probably find the next level of support. So there's really no way to tell. Right now it's a coin toss going into, for example, Tuesday and then Wednesday after that. We'll have to see how it goes, but we should be getting into an area, if we can find a low here, where you get some kind of a multi-week rally. That's what we're looking for. So that's the end game right now on the short-term basis. The end game is to find a low here within the next few days, and we should see a multi-week rally off that low. How high the rally goes, we'll have to see where the market winds up and how it handles it. So it's too early to tell, but that's what we're looking for. So I know that's long-winded to get to the point, but we're looking for a multi-week rally, but we have to find a low first. And if this was the low, maybe, or if we find a different low, we'll have to take that one day at a time. We're just going to have to let the market indicate to us what the next move is. And right now, it just hasn't indicated that this is going to be a definitive low yet. All right. My other favorite, or one of my favorite market indicators, is the IWM. We'll just take a quick look. But the issue here is it looks pretty much the same as the SPY. So it's not really telling us anything different one way or the other. It was up nicely, about 1.5% on Friday, but it's not really telling us anything different than the S&P 500 is telling us. So we're going to have to just leave that one alone. Next up, we'll have crude oil. Let's take a look at what we have there. We'll look at the USO, and what we did was had a nice little update in the USO again, but we're not making any kind of a definitive low here yet. And you also have the couple of things going on in Europe that are important to talk about this weekend. It relates to oil. It also relates back to the market. But you have, last week you had this unpegging of the Swiss franc to the euro. Okay, so that sent the Swiss stock market in turmoil on the downside. It sent the the Swiss franc up against the euro, and basically, everything's going haywire, and there are firms that are exposed to these currencies that are, potentially becoming insolvent or owe a lot of money. FXCM was bailed out and all that stuff. So the ECB, I think, is Thursday. Mario Draghi is going to announce his, or the lack of his, next bond buying or stimulus type program. So whether or not anything comes of that this week will have to remain to be seen. But if the market is being driven down into that announcement, you may look for a reversal around that time on that news, okay? Or if the market's going up into that announcement, it could be a sell the news event, and that's why you need to be careful. And that's really another point I wanted to get to, is being careful that could be a buy the rumor, sell the news event. By the rumor that the ECB is going to do another bond buying program, another quantitative easing program, and then we're disappointed in the news and the market sells off. So these are the things they have to be aware of, and that's why the cycle turn day was out the window, because the market really didn't go up or down definitively into that area for many days in a row. It was just a one-day wonder. So we're not going to read into that one. So the reason why I bring crude oil up into that conversation is because depending on whether or not if Draghi and the ECB announce something and maybe the dollar perceives it one way, the dollar market perceives it one way, the euro market perceives it another, that could also impact oil. If you get a pullback in the dollar of any significance, you may get a rally or a spike in the price of oil as well. It's one of the reasons why oil's been so weak, is because of the strong dollar, and the dollar being strong, every oil purchase has to be converted into the dollar currency. So if you're converting it into a currency that's weakening against the dollar, that puts pressure downward on the price of oil. Strong dollar, lower oil prices, okay? Now, let's go over to gold market, and the gold market pretty much is playing out even better, at least in the short term, than expectations, right? So we started saying seasonally strong period for gold here. We were accumulating down here. We said 1240 to 1245 was the first target. I said or higher. Didn't really know the or higher was going to happen, but that coincides with this level here, okay? And then the or higher, we're still jumping higher. So in the price of the gold futures market, looking at the February contract right now, we're at 1277. I've got to think, since we're too close to this area here, coinciding with the 123.75 level, roughly in this gap fill here, it just looks like it wants to go higher, and I think we're probably going to go up into this 125, 126 area in GLD, and I think that coincides with the, let's say, 13 to 1310 area in gold futures. And the reason I give that range is because 13 is a big round number, but I think we probably pierce through it. So, a $5 or $10 pierce through 1300 is probably not out of the question. And then we'll have to see how the market reacts to that level, whether or not it pulls back from there or continues higher. The next target I have from there, believe it or not, is 1340 to 1350. But we're very extended, so I have to think that if we reach the next target of 13 to 1310, that will probably pull back from there. But we'll still take it one day at a time and let the market tell us what to do. Last thing I'll discuss in this video is the, let's go to the bond and interest rate market. Let's take a look at TLT, for example. And TLT had pretty good reversal down here a couple of days after this spike up higher. I don't know if we pull back more from this or move higher, and that's another reason why I'm a little skittish in calling the market one way or the other, because there's really nothing wrong. This is still in an uptrend, and the 50 period and the 20 period is actually widening even on the daily chart. So that tells you that this is a strong market in an uptrend. However, it does need to come back close to home. Remember, I always say that the 20 period moving average is like home base. So every time we get too far away from home base, we come back to home base. Far away, back to home. Extended, back to home. Extended, started to move back to home. Here we go again, starting to move back to home, but we can obviously go higher. We'll have to see how that plays out and what the days and this week have to bring in front of us. So I think that's pretty much all I had on the list of stuff for today. And hopefully it's helpful, folks. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.